If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
What's going on, everyone? I'm Shawn Winslow, and this is the Multifamily Money Podcast. Welcome back to another Multifamily Monday episode. This is part 2 of our part 3 series on raising private money. This is one of the topics, in my opinion, for this whole real estate investment game, because when it comes down to it, yes, it's the deals, but it's the money, man. The money is in the money. That's he who has the gold holds the power, has all the leverage. So true. You can find a great deal, but if you don't have the money, it's not happening, right? And that's obviously so obviously comes lenders, right? That's an important part of it. They're your biggest investor. But today we're talking about the equity slice of the game. So the lender brings, anywhere from, 60 to 80% of the deal. And then the equity has to bring the rest, including if you're going to do any renovation, the CapEx, reserves, closing costs, all that good stuff. That's what the equity is bringing. And like I said, it's the money is in the money. And he who has it has the power. And so on today, we're going to be talking about strategic partnerships. Last week, we talked about raising money from your network, your friends, family, and your greater network. And like I mentioned, for me, that's my goal in the end, is to solely raise money from my network. Now, yeah, I still might have to strategically partner with strategic partners or with institutional money like private equity, family offices. Sure, depends on, at what point, how fast we want to scale. Like right now, we're in big growth mode, right? We want to grow our company, our portfolio, and so that's going to take other partners, not just our network. But I wanted to get to a point where we're at a point where it's more opportunistic. We don't have to grow as fast. So that means, I'm not going to tap my network as fast, right? We already have that scale built out in our portfolio. So we don't have to grow as fast. We still could, right? But we don't have to. And that's kind of the place I envision myself and my team at in the future. And there's a lot of benefits to that, right? Obviously, you get to keep more of the deal when you're just raising from your own network, right? You don't have to give a portion of your GP away to bring in other partners to get the deal done, right? Essentially, you get to a point where you're the only general partner on the deal, and you could, you own 100% of that general partnership. But to grow, sometimes you got to bring in other partners to get it done, and you're going to have to give up the general partnership, obviously. But then the downside to that is, everything goes on you when you're the only general partner, right? Investor relations is going to be a big part of it if all the investors are solely yours, right? And that's a big job. That's an important job, customer service, investor relation. That's huge. And at that point, you're going to have a team built, right? That takes care of that. It can't just be you as a sole operator taking care of all of that. So again, it goes back to like, how do you want your life and your business to be? If it's something where you want a big team, then that's the way to go. If it's not, then maybe, getting to the point where you're solely raising money just yourself, maybe that's not the way you want to go, because it does take work to cultivate, not just to grow it, but to cultivate and keep it there. Because it's all about, repurposing those funds, right? Keeping those investors and the referrals that they'll give you. But like I said, today's not about that. So it all depends where you want to go, where you envision yourself and your business. And today's topic is about strategic partnerships. So these are individuals that have their own investors that they raise money from to go into deals. And what a lot of general partners and syndicators do is they partner with one another, right? There's some people that are really good at finding deals, underwriting deals. They're really good. Some are really good at broker relations, and then some are really good at raising money, right? And they all partner together, and then you'll have someone, who's a really good operator, and you'll all partner together to combine all your strengths, right? And then eliminate any weaknesses that one individual may have. And I love that starting out, right? Because doesn't matter who you are. When you're starting out, you're not going to have 100% strengths on every aspect of the business, right? No way. And if someone tells you they do, that's a lie. And you want to stay away from them. So I think it's important to partner with people at the beginning, right? Now, obviously, depending how many people you're going to partner with or need to partner with is going to limit you on how much, the general partnership you can keep in your own deal. Or you could potentially be brought into someone else's deal. That's a great way to get started. If you have a network there that you can tap to raise money, that's a great way to get into a first deal. Obviously, SEC standards, you can't get. That's not the reason why you're getting paid to raise money, right? You have other tasks within the general partnership to keep above board. But that's obviously a strategic part why you're brought in, right? Because you're not only are you giving your sweat equity, but you're raising your capital from your investors to go into that deal, and that's a great way to get into a first deal because obviously it's hard locking up a deal if that's your angle because you don't necessarily have the track record for a broker or a seller to want to pick you, especially in a competitive market like today, unless you're able to leverage someone else's track record, which I have talked about in the past, and that's a great way to go about it if you're going to go to that angle. But obviously, this is not what this topic is about. We're talking about raising money, so it's a great way to get in on a first deal. And from a strategic partnership standpoint, the key is just like anything, it's building relationships because you could have a deal and you could find someone that has raised money in the past for other deals. And that's how they get into deals is they're really good with that. But if they don't know you, if they don't like you, if they don't trust you because there's no basis for trust yet because the relationship's so new or it's not even a relationship at this point, it's just you just met, they're most likely not going to bring their investors into your deal, right? So this is like anything, it's all about building and cultivating relationships to build these strategic partnerships. And these are syndicators that they solely focus on raising capital. And okay, Shawn, well, where do you find these? There's plenty of places. Multifamily meetups, online meetups, podcasting, multifamily Facebook groups. That's where they all hang out. And probably the best way to do it is to go to conferences, especially now that conferences are in person and live again. You go to these multifamily conferences, and that's truly how you build, relationships where they get to know, like, and trust you, and therefore want to partner and do deals with you. Because I'm sure it's much easier to build a relationship in person than it is, virtually. I'm not saying it can't happen. It definitely happens, and I've seen it in this business. But for me, it's much easier to build a relationship in person, just, feeling the vibe, the connection, and really getting to know that person and spending time with them. So what are these kind of conferences? Well, generally the conferences you're going to go to find this type of individual is going to be, like multifamily, like education conferences, right? So think of the Best Ever Conference, Michael Blanc's, what's it called? Dealmaker Live, I think it's called. You got Jake and Gino, REI. There's the Brad Sumrock group. The list goes on and on. Those are the ones where you're going to meet other syndicators, and that's how you're going to form these relationships, build these bonds. And the key here is first you got to get to know the person. They got to get to know you. They got to like each other, trust each other. And you also want to make sure that just your personalities are going to match and you're going to be able to work together, right? The best is when you can find not only the strengths and weaknesses in terms of like your roles within the GP, but also your strengths and weaknesses outside of that, just as like human beings and business people, and really make sure they match. And then once you get to that standpoint, you want to know, like, what have they conditioned their investors to look for in terms of a good deal, return metrics, because everyone has, their own little nuance, their own, criteria. So, it can get tricky to raise if you're used to raising maybe a certain way where it's a pref and then a split on the back end. That might be hard to pitch it to someone who does, a pref and then a waterfall. And for those who aren't familiar with that, a pref is just a preferred return that's usually paid out of the cash flow. So say it's a 7 pref, you get a 7% preferred return on your money every year. And preferred return is just after, expenses and mortgages paid, the property, you as the preferred equity partner, the limited partner, gets paid before anyone else. So before the general partners and so on. And on the back end, a split could just be like a 70-30. So 70% of anything above that on the back end goes to the limited partners and 30% to the general partners. And then that ratio can go up and down. And then a waterfall, this is where certain return metrics need to be hit. And then the split either, usually gets smaller, more favorable in the general partner. It's an incentive for the general partner to really make the deal perform, because the better the deal does, the better they get paid. So for instance, it could be, after your preferred return, the limited partners get 100% of everything else until they get to a 12% average annual return. Then from 12 to say 14, it goes to 70-30 split, 70% to the limited partners. And then once you hit that 14, or it could be 16% average annual return, then it goes to a 50-50 split. And there can even be even more layers of a waterfall. It all depends how you set it up. But the point of this is you want to know what their criteria is and how they've conditioned their investors, because it could be really hard to pitch to a certain group of individuals if you're just totally off base of what they're normally accepting in terms of a deal structure and return structure. For instance, I have a mentor who does kind of a pref and a pref. So it's a pref on the front end and pref on the back end to total a certain, say like 12 to 16% average annual return, but they don't share in the upside. And that can be very hard to pitch to someone that is used to a split or a waterfall on the back end where they participate 100% in the upside, or at least to a degree on the upside, right? So that can be very hard to pitch to someone. You just want to know, what I do is we have a spreadsheet where we have our strategic partners, all their information, and then their criteria. So then when we get a certain deal and we're structuring it, we know, this will work for them, this won't work for them. And then as I'll talk next week about institutional money, like private equity and family offices, their criteria is even different. So you got to know who this deal needs to be pitched to, right, as you're growing. And I think as you probably can tell right now, this is another pro to having your own investor list that's all you raise from, right? Because you've already conditioned them. They already know what to expect when you bring them a deal in terms of deal structure, return structure. This just makes it easier on you, right? You don't have to reinvent the wheel in terms of explaining your deal structure every single time you have a deal. They just are already know and are familiar with it. The point is to go to these conferences, go to these meetups, these online networking calls, Facebook groups, LinkedIn. That's a great one too. LinkedIn over probably the last 18 to 24 months is probably one of the best places to find money. And this goes across all major categories you can raise from. So from your own personal network to strategic partners to institutional money, they all can be found on LinkedIn. And trust me, I found every single one of them on LinkedIn. Some have even reached out to me on LinkedIn. It's just it's a great place to be. So I would recommend LinkedIn for all these strategies I'm going to be talking about over this 3-part series. So once you have, your list of strategic partners, it's important to keep cultivating them, right? It's not just like, okay, I met you at this conference. Sweet. I got your information. No, you really want to keep building that, maybe if you have a podcast, invite them on. That's a great way, right? Because you're providing them value. They can get their name out. Send them, keep them up to date on deals you have. Obviously, keep them on your newsletter. I like to send little gifts. I know you guys have probably heard me say this multiple times in different aspects of the business. I just like to stay top of mind and also, let them know that I appreciate them, right? No matter who you are, if you're in my life and my business, you're there for a reason. I appreciate you. And I hope you appreciate us and want to stay within our sphere. So I'll send them little gifts, send them holiday cards, all that good stuff. And the point is just to cultivate a relationship, because I like to let people know I'm not in business to be transactional. This is to foster like true relationships that we can all grow together and just have a good time and be a win-win for everybody. So that's really important. And these strategic partners will really let you grow quick. And a great thing about them is how I mentioned earlier in this episode, this episode, the money's in the money, right? He who has the gold. It's not really that way when it comes to strategic partners. And what I mean by that is usually you're bringing on a few of them, right? So it's not one person writing the check. It's 3, 4, 5 of them coming on, raising a portion of the raise. And so, they all want this to make it work. So they're not gonna, try to stiff you or play hardball for the most part. Like obviously there's outliers and everything, but from my experience and what I've seen and what I've heard from other operators, that's generally not how it works, right? They just want to be in the deal with you. They know it's a great investment for their investors and it's a great investment for them as well. So that's why I like the strategic partners. Now, when you get up into, some of the institutional players, it can be the easy button once you develop that relationship in terms of the raise part. They also hold a lot of leverage because they write, 80, 90%, write a check for 80, 90% of the raise. So that's what's really cool about the strategic partners is that it seems like it's more camaraderie. Everyone's in it together and, they can be easier to work with. All right, so this is pretty much all I really had to say on this episode. The main thing to think about is, what kind of life are you trying to build, and how does your business fit into that? And if you want, if you're more focused on finding deals and you don't want to worry about raising capital, strategic partners is a great way to go. And then obviously next week's is too. But maybe this episode will tell you, I don't really want to find deals. I love meeting people. I love networking. I love helping people grow their wealth. That's what I want to do. And then if that's the case, more power to you. That's awesome. Each one of these roles is important, right? And like I mentioned earlier, the money might be the most important part, right? And it's a lot of it out there right now. And there's a lot of money chasing yield. And as crazy as the world is, there's a lot of money going to the multifamily market. So that could be a great avenue if you're interested in that. All right, so this was the episode on strategic partnerships. Hope there was value found here. As I mentioned before, as always, if you do find value, please share it with anyone who you think could also find some value out of it. And I'll catch you next week for part 3. Have a good one.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is an investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course share it with a friend who needs it. See you next week for another great show.